Well, good evening, everybody. Welcome back to Strongman Personal Finance. We got some dire news from billionaire investor Paul Tudor Jones. In this video, in this clip from CNBC, Paul Tudor Jones is being interviewed by some CNBC rat. And in the video, he talks about some interesting subjects that I actually 100% agree with. So let's see what he has to say about how we're going broke quickly in the United States and what it could potentially do to our economy. Let's watch.
Okay. Because that's how the money is going to get raised.
Correct.
One way or the other.
Correct.
I think we have a screen, if we could, that puts up a little bit of a menu here.
Yes.
Of, I don't know if it's options. Actually, they may not be options at all.
There are plenty of options.
But there's not many ways to get where you need to go unless you start to do some of these things.
Correct.
Maybe. So the question is, of what's on the screen, you can let the tax cuts expire. That gets you
can I just say this?
Yep.
You have to let the tax cuts expire.
Okay, so right now they're talking about the federal deficit and federal debt as compared to the nation's gross domestic product or the national income. So I know you guys think you're all geniuses, and I know you think America has magic soil and our companies are just intrinsically better and we're all magical and amazing. But in reality, the reason our economy, our private sector is doing so well is because our government is turbocharging our economy by spending like crazy and not collecting enough tax revenue. And when you spend more than you collect as a government, you gotta borrow money. And the amount of money you borrow shouldn't be looked at in like gross terms. Like, oh, we borrowed $1 trillion. How it should be looked at is as a percentage of the national income. What percentage of our total national income for a year was borrowed by the federal government to juice the economy? And we are juicing the economy because we're not taxing corporations and people, individuals, enough to actually fund the amount that we're spending. And yes, governments can run deficits, but they can't do it forever, okay? There is a limit. I don't know where it is. You don't know where it is. Nobody freaking knows. But the government cannot keep doing what it's going to do, what it's doing right now. Let's listen a little bit more.
You have to.
You have to let those expire. That's $390 billion. We're going to have, again, we're gonna be broke really quickly unless we get serious about dealing with our spending issues, and unless we can either, I don't know if we'll be able to cut spending that much. 60% of our spending are transfer payments.
But if you think we're going broke, and you think Trump is going to be the president, he's not going to let those tax cuts expire if he can avoid it.
The thing
he does not want the corporate tax rate to go to 25%, as you're suggesting it'll have to. He's suggesting it should go to 15%.
I'm saying that just to get us to the point where we stabilize debt to GDP at where it is right now, here's what you need to do. You need to let the...
Okay, so the interviewer is 100% correct. Trump wants to cut taxes, okay? And here's what's going to happen. There's probably going to be an extension of the Trump tax cuts. We actually did get tax cuts for everybody. He wants to lower the corporate tax rate to 15%. It's currently 21%. And he wants to continue the Trump tax cuts. And do you think he's going to raise payroll taxes? What are payroll taxes? Those are taxes assessed on your earned income, on your wages, up to a certain limit for Social Security and basically infinite for Medicare and Medicaid. Okay? Payroll taxes come directly out of your paycheck. It is currently 6.2% that is charged to you and 6.2% that is charged to your employer. And according to this, to stabilize debt to GDP, to stop our debt from going up faster than our GDP, we have to let the Trump tax cuts expire, $390 billion, not going to happen. And we have to raise payroll taxes by 1%. So now an additional 1% of your income is going to go to Social Security. It's going to be transferred from you as a worker to somebody that's retired, living off the high hog, okay? And your employer is probably going to have a 1% increase in their payroll taxes because your employer also pays 6.2%. Did you know that? Social Security consumes 12.4% of your income. And this could potentially be 14.4% of your income. Do you think we're going to do this? Do you think we're going to raise the corporate tax rate to 21, from 21 to 25? No. The debt to GDP is going to freaking explode. Temporarily, this will turbocharge the economy. As long as our government can continue to sell debt and service the debt, everything's hunky-dory. But it's going to massively explode the debt over time, and there will eventually be a reckoning. And you think you're smart because you got your vertical lines these last couple of years. The chickens will come home to roost at some point. It's starting to get crazy right now, okay? And here's how bad it is. Here's how freaking bad it is. So here's the U.S. federal deficits as a percentage of the national income, okay? So basically, the higher the bar, the larger the percentage of the country's GDP we've spent in government deficits. We've collected less than we've spent as a federal government. What do you notice? Well, before the great financial crisis, we had a tiny deficit, okay, 1.1% of GDP, nothing crazy. I mean, that's normal for a government. And then we had 2008 roll around. We started to have some issues, and we spent 3% as a percentage of GDP. And then our deficit exploded to 10% during the financial crisis, which America destroyed the world, and then we suffered no consequences, basically. When we go through crises, the government makes up for issues in the economy. They launch massive programs to bolster the economy. That's normal, okay? The government does that. That makes sense to me. And then we see the deficit as a percentage of GDP go down. Do you see that? And it was actually during the Obama years when it went down. And then during the Trump years, it started to tick back up, and then it exploded during the pandemic. Once again, it makes sense during the pandemic. Makes sense. Okay? But when there's not an economic crisis, you should not be running massive deficits as a percentage of GDP. And now we're in 2024, and we're running a 6.23% deficit as a percentage of GDP. During booming economic times, maybe the booming economic times are a result of this, geniuses. Now, bro, we're just magic soil, bro. Okay, this is not good. And I have a suspicion this is going to explode because we're not going to raise taxes. We're going to lower taxes. We're going to freaking lower taxes. And if we have inflation and the Fed has to raise rates again or keep rates stable, our government's going to be spending more and more and more. Less tax collections and more on interest. We're in a very dangerous time. This could last for years, but we are in a dangerous freaking time. Okay, let's keep watching a little bit more.
Trump tax cuts expire. That's $390 billion. You need to raise the payroll tax on every single working person, 1%. That's another big slug. You need to...
What do you think that does to jobs?
We're clearly going to have a period of contraction, which hopefully, that's why I was going to say...
Did you hear that? This is not a party in the USA, okay? When you're borrowing money like crazy and spending, oh, I'm rich, bro, I'm rich. And then eventually, people stop lending you money or they demand higher rates. And then you get into freaking trouble, okay? He said contraction. I agree. At some point, something nasty is going to happen to our economy. Party in the USA.
It's going to be really important for the Fed to be able to offset the fiscal contraction area that's going to come.
Then you want to increase the individual tax rate all the way to the top rate of close to 50%.
No, hold it.
Yep.
I don't want to do any of this stuff. What I'm telling you is that we've got to be serious about where we are fiscally. And so I'm giving you, there's a whole set of options, right? We could go in and cut 25% of the federal workforce. Some people may do that.
We'll see. I hope that happens, but we'll see.
There's a website where you can go look and play with all the options. You can raise the capital gains rate from 21 to 28%. That only gets you $10 billion a year. It actually doesn't get you what you need. So I'm simply showing some of the things that you can do. Yes, you'd have to raise the tax rate on the top, I think probably everyone over 200 grand, probably have to raise that to 49.5%. If you do all these things, raise the Social Security from 65 to 70. If you do all these things, means test, Medicare, if you do all these things, all you do is you get to a primary balance. What that means is you stabilize debt to GDP. You're still actually increasing your debt.
Right.
You're still actually increasing it because it excludes the interest costs, which, oh, by the way, the interest bill this year is larger than every single line item except Social Security. It's larger than
Yes, we're paying a lot of interest right now because we're trying to bring inflation down. Now the Fed's starting to cut rates, blah 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 blah, and Trump's going to put pressure on the Fed. Okay, they're supposed to be independent. He's going to tweet and rant and ramble and put pressure on the Fed to cut rates, and that'll turbocharge the economy and the stock market, right? But it could also reignite inflation if you cut too early. And we're raising tariffs, and we're deporting people. I wonder if there's going to be inflation, perhaps. Okay. And best of all, look at the Social Security Trust Fund. So right now, Social Security, what it's always been is workers pay taxes, and that money gets immediately transferred to retired people. Straight to them. Boom. Your paycheck, well, obviously Social Security processes it, but it goes to the old people's paychecks, their Social Security. And in the past, any excess collections were put into treasuries inside the Social Security Trust Fund. This trust fund is starting to be depleted because we are collecting less tax from workers because we have fewer workers per retiree. And because of that, we have to dip into our Social Security Trust Fund. And it's projected to go dry by 2030. That's 5 years away. But hey, it's a party in the USA. Hey, come on. This little party celebration bubble that we're in, there's going to be a reckoning. Maybe we'll have some fun in the stunk market for the next couple of years. But there will be a reckoning. Taxes will go up. There will be a contraction. We can't party in the USA forever. Okay? This is not good. Let's keep watching.
Defense spending, larger than Medicare.
I want to talk about why you're here, which is Robinhood and this conference. But before I do that, is this, given all of the things you're saying, are you off buying gold and Bitcoin and
I think all roads lead to inflation. We're going to end up, but does all roads lead to inflation? Therefore, gold is a good investment. Is Bitcoin a good investment to you? I'm long gold. I'm long Bitcoin. I think commodities are so ridiculously underowned. So I'm long commodities. I think most.
Well, this guy's a trader, but I disagree on that.
Young people find their inflation hedges via the NASDAQ. That's also been great. It's probably some combination. I probably have some basket of gold, Bitcoin, commodities, and NASDAQ, something like that. And I would own zero fixed income. If I had my cash, it'd be very short term. The playbook to get out of this, you see it in Japan right now. They have 2% inflation, 30 basis points overnight. They don't want to raise rates. The playbook to get out of this is that you inflate your way out and you have a small tax on the consumer and you run interest rates and nominal growth rate, interest rates below inflation and nominal growth above inflation. And that's how you reduce your debt to GDP. So you're going to have the Fed they should be easy. They should be
easy. You want them to cut.
So just real quickly, every 100 basis points, given where our debt to GDP right now, every 100 basis points is worth about $90 billion a year to the deficit. $90 billion.
Inflation's coming, baby. It's coming back. But people that own stock, like me, will be fine. The average person is about to get a shellacking in their rear end. Okay? And they're going to raise your freaking taxes, especially the payroll tax, which is a freaking grift.
So, yes, if we're trying to stabilize debt to GDP, we want to run the most dovish monetary policy that we can without letting inflation become too much of a tax on the citizenry. So, yes, all roads lead to inflation. That's historically the way every civilization has gotten out, is they've inflated away their debts.
So what do you think about that, ladies and gentlemen? Is it just a forever party in the USA? No issues with Social Security. Federal deficit as a percentage of GDP, historically very high during a period where we're supposed to have a great economy. Does it make sense? I'm trying to wrap my head around this, okay? Maybe it's a new paradigm, bro, where U.S. stocks, U.S. bonds, U.S. deficits, U.S. interest, bro, everything, bro, U.S. stocks, bro, everything. Maybe it's just a new paradigm. Or maybe hard times will be coming ahead. Like subscribe. Check out my tax services in the pinned comment below. I'm a certified public accountant. I do taxes in every state in the United States. 100% virtual. I give you free consultations. You can talk to me for 30 minutes for free while I review your tax situation. I then give you an upfront quote, which does not change unless you hide stuff from me. Check out my tax services, book a free consultation, and I'll see you guys in the next video. Cheers!